All right. So a very warm welcome to all the attendees of this webinar number 21. It's almost difficult to believe that we've covered 21 sessions till now on different topics. And I'm really glad that you guys have been attending it through the entire previous week. Also on Saturday, very, very interesting session we did on Saturday. So you should take a look at that from Shardul and DSD Consumer Partners, and also Sagar Mehta from Vegan Dukan. Multiple insights on distribution, on aspects of marketing, go-to-market, and first-hand experiences of what these organizations are looking at in terms of smart protein startups and supporting them. So make sure you kind of go through that recording that has been sent to you. And a very warm welcome to this financial modeling and unit economics session, workshop/session for the smart protein sector. Obviously, our expert speakers for today, as you know, is Divya Murthy, who's the Senior Investment Manager at ProEdge Incubator. She's been working for the past couple of years with a lot of alternative protein startups in Germany, also the cohort from India and multiple other parts of the world who have applied to ProEdge Incubator are the ones who are in touch with her. So she understands the space, understands early stage startups and their fundraising requirements, their financial modeling aspects, and usually also coaches and guides a lot of startups in these areas, amongst many others. So obviously, ultimately, if you're applying for the ProEdge incubation cohort, I think it'll be great to understand what Divya has to say from today's session, and then obviously keep in touch with her as well. And as I was saying, we also have Debabrata and Pranjuli Garg, the co-founders of ProMeat, which is now called ProPlant Foods Private Limited. ProMeat, as you know, is one of the demo day teams from ISPIC 2020. Last year, they started their journey from the very ideation stage in ISPIC 2020, and they went through the entire challenge. Last year, they applied for the multiple cohorts of acceleration incubation. They got some grants. They went through the ProEdge incubation program, and they're currently looking to go to market and raise funds, and are also part of our ISPIC 2021 cohort. So very excited for them to also join us today and share their learnings and experiences, so that our participants and anybody who watches this recordings finds it helpful as an early stage startup kind of making their way in the smart protein ecosystem as it currently stands globally and in India. And I am obviously Shardul, Dabir, the Innovation Specialist at JPI India. And it's a pleasure to have you here today. Just a quick couple of announcements before we get into the session. A big thank you to all our title sponsor, Capri Global, key sponsors, NICE and Alchem Foundation, and our organizing partner, CIECO, and a multitude of supporting and academic partners from all over India, and our smart protein ecosystem partners. ProEdge Incubator is one of them as well. So we are really glad to have Divya today, as part of this knowledge webinar. And a quick announcement, like I said, we've received almost 42 entries till now for our smart protein solution wall this year. We are going to share this with all our ecosystem partners, sponsors, partners, but at the same time, investors, corporate professionals, other entrepreneurs who are looking to hire talent from Track1 perhaps, etc., so that your ideas are showcased to the world. I still see few teams have not submitted for it. So please submit it as soon as you can by the end of the day today. The form is still live. If you've missed out, please submit it as soon as you can. I just wanted to quickly show you all the solutions wall as well, so that you kind of know where I'm coming from. So really quickly, just pulling that up. Here's the solution wall for this year. As you can see, there are multiple teams here. You can put in a filter. You can just sort them based on their category. If you want to just look at plant-based companies or fermentation-derived companies or cultivated companies, or ideas or teams, you can do that from here. And then basically you can take a look at all of their submission, the team details, so that you can get in touch with the primary team member. And then you can also understand their technology sector focus and end product focus from this database. So hope that this also further, kind of just increases collaboration and networking within the cohort, and also helps you discover the right opportunities going forward. Having said that, a real warm welcome to Divya to join us for this session. So really quickly, telling you a little bit about Divya. She is going to take us through aspects of our session today, thematic session today, and I'll let her, Debabrata and Pranjuli, introduce a little bit about them as well before we get started with the session. So Divya, on to you.
Sure. Thanks so much, Shardul, for the warm welcome. And I'm really glad to be here and have this opportunity to interact with the participants of ISPIC. Just to introduce myself, I'm the Senior Investment Manager at the ProEdge Incubator, and I'm leading our investment initiative. I've been working here for 1.5 years now, and it's been a really interesting experience to learn more about this space and collaborate so closely with the founders who are trying to change our food system. Before joining Proveg, I was working in roles like M&A consulting, including due diligence, corporate credit rating, and risk advisory. So it's been really varied. So I have about 7-8 years of experience in this space, and I believe I've learned a thing or two that I would be more than happy to share with you guys today. The real idea behind the session and what I hope to achieve at the end of this today is to just kind of prepare you and give you a foundational perspective to the fundraising process. And hopefully that helps you in your conversation with investors when you move forward in the process. Yeah, thanks.
Fantastic. Debabrata, Pranjuli, real quick introduction. So we get started with Divya's deck. Go on, either of you, that's fine. Pranjuli or Deep, if you want to just say hi and quickly introduce.
Yeah. Hi, everyone. This is Pranjuli this side. So I'm the co-founder of ProMeat, and a brief intro about me. I've done my BTech from NIFTM, which is National Institute of Food Technology, Entrepreneurship and Management. So a little brief about ProMeat. So ProMeat is a food tech and science startup, and we are working for the food IDU who also cares about the planet. So a little about the vision of ProMeat. So we are on a mission to bring about a mammoth change in the way people consume proteins at the moment. Our company name ProMeat is based on the fact that we are totally promoting meats nutrition. We want people to have that nutrition, but in a more sustainable, healthier, and animal cruelty-free way. So that is our entire vision behind it. Now I would like my co-founder Debabrata to introduce himself.
Hi, hello everyone. So myself Debabrata, so I am a co-founder of ProMeat. So basically, we started this whole venture last year in Smart for Innovation Challenge. So after that, it's been a warm introduction. Basically, we understand how exactly we move forward with the idea, and now we are at a stage we're taking this forward. So in our whole presentation at the end of this session, you will get an idea how exactly we started with our idea to the final stage of our product line. So very excited to see how exactly you guys are doing this whole space and working in this whole ideas and different aspects.
Fantastic. So very warm welcome to all three of you, and we'll get started with your deck in the second half of the presentation. So Divya, I'll let you share your screen and take us through the session. You're on mute, so we can see your screen.
Yeah.
Startup finance. Yeah, perfect.
All right, great. Awesome. All right. Are you able to see the screen after this as well? All right.
Yeah.
Cool.
Yeah.
Okay.
Perfect.
Great. So let me just quickly get started with a short introduction about ProEdge Incubator as well. As some of you might know, ProEdge Incubator is part of Proveg International and is an initiative run within that organization. And these are the 5 reasons for us to be pro-veg: is pro-taste, pro-health, pro-justice, pro-animals, and pro-environment. Our mission is reducing the global consumption of animals by 50% by 2040. And our vision is a world where everyone chooses delicious and healthy food that is good for all humans, animals, and our planet. So just a quick summary of our achievements so far at the incubator. Since our launch in 2018, we have helped and supported over 55 startups. We have helped them launch over 100 products, 100 SKUs, and in over 15,000 points of sale. And we've also helped them achieve a phenomenal 220 million euros in fundraising. And we hope to be able to continue doing this in the near future. And our applications are currently open, and the deadline is 31st Jan. So we're more than happy to hear from some of you. All right. Before we get started, all right. Here we have just a quick top reasons for why startups fail. And as most of you can see, they run out of cash or have failed to raise new capital. And this is one of the primary reasons why startups fail. Now, the aim of this entire session is to kind of try and prepare you for this. Not all of this can be resolved, but everything that you can do from your end to try and counter this issue, we hope that you can we hope that you're fully prepared to kind of prevent this from happening from your end, at least, everything that's in your control. So what can you do in this situation? All right. You ensure that you have at least a 6-month runway. We'll get to what runway means. We ensure that you review your financial performance regularly after you launch your product, after you launch your startup. You keep a close eye on your financial performance. You ensure that your cash balance is sufficient to kind of pull you through. And you also build a robust forecast so that you can plan well. A forecast is not just something you present to investors, it's also something that helps you prepare and monitor your financial performance and ensure you're meeting the targets that you set for yourself. So this is broadly what we're going to try and cover in today's session. All right. So what are financial statements? Financial statements are a record of all your financial activities of any business. We have 3 primary statements. The first one is your balance sheet, which is a statement of all your assets and liabilities, what you owe and what you need to pay, what you owe and what you need to get, essentially. And you have your equity, which is your founders' capital, investors' capital, and all of that comes in here. Then you have your income statement, which is a statement of all your revenues, your expenses, and finally profit or loss. And then finally your cash flow, which is divided into 3 different segments. You have your operating cash flow, your investing cash flow, and your financing cash flow. We're going to go over each of these items independently. All right. So this is Beyond Meat's income statement, just a quick snapshot to kind of guide you over what are the different components. We have revenue. We have all the operating expenses. This is everything that goes into generating that end product. So this would be all your direct costs, all your indirect costs, all your administrative costs that go into finally producing your product. And finally, that then gives you your final profitability, or in this case, losses from operations. And ultimately, then you have your list of non-operating expenses and incomes, which is your grant income, interest expenses, and all of these other components that are not part of your direct operations. Finally, you have all of these items need to be for a specific period of time. And you need to abide by the matching principle for this reason, and all your expenses need to be aligned to all the revenues of a particular period. And this is one of the fundamental principles. Okay, then we go into cash flow. And cash flow, like we discussed earlier, is just a statement of all the cash coming into your business and all the cash going out of your business. And this is different from the income statement and your profits, and we will discuss that just in a short while. Operating activities include all your net income or losses, all your non-cash expenses or income. This would be depreciation and amortization, any changes to working capital, and ultimately you have your cash from operations. If you have any questions, I'm more than happy to so just pop in and share your questions, or I'll have a look at this maybe a little later during, in between 2 sections, all right? Okay, so operating activities, net income or losses, you have your non-cash expenses or income, you have your net change to working capital, and all of these together give you your cash from operations and cash from operating activities. Then you add your investing activities, any purchase of assets. If you're setting up your own business, if you're setting up your own manufacturing unit, you have all these assets that you will need to purchase to kind of produce your final product. Maybe you might have some sale of assets, and together both of these will give you your cash from investing activities. And finally, you have your financing activities. This is all the money you will get from investors, all the money you get from banks, any repayments that you need to make on your debt, and ultimately this gives you your financing activities. Together, your operating, investing, and financing activities are present the net increase or decrease in cash. You add the cash you had at the beginning of the period, and together this will give you your cash at the end of the period, your closing cash balance, essentially. This is a very important statement. And since most businesses run out of cash and therefore run out of business, this is something that you all need to be aware about and learn and be mindful of and keep a close eye on your cash balance at all points of time. Okay, so we're going to dive into a quick exercise at the moment. I'm just going to stop sharing my screen now, and maybe we can take any questions.
Yeah, so I think one question was around Beyond Meat's deck slide that you had. So if you can check it out in Q&A.
Yeah. Yeah, I'm not sure if I think these are in thousands. Yeah, not in million. Okay, cool. All right, any more questions? At this point, you can type me the question in the chat as well.
And if any of you have a question, you can raise your hand. I can promote you and you can ask it live with more context of what you're working on.
Yeah. Okay, so I'm just going to share my screen. Okay, for startup, do you see cash flow more, or I would say both. Income statement is important from a profitability point of view, and cash flow is extremely important from a survival point of view. So I would say both are equally important. Maybe cash flow a little bit more.
So one question is from Yash. How would you suggest projecting financials for a company that doesn't have any earnings? Basically, it's all in projection work on what the needs might be, like a very early stage startup who hasn't really gone ahead and actually spent anything or invested in anything or have no operating revenues. How would you suggest the best way of going on about this exercise for them?
Yeah, I mean, this is typical for any startup that doesn't have any financials, doesn't have any actual performance, and everything's a projection. And this is very typical. So it's not an exceptional scenario. So in all these cases, all we expect is that you at least have an MVP, a minimum viable product, and you have your financials to kind of support how you're going to go about launching your product and getting to market. So the whole idea is to kind of, with financials, with projections, is to try and evaluate if the founding team has thought about the different aspects or thought about all the aspects that need to go into ensuring that their venture and their milestones are met. So that's the whole purpose. So it's converting your milestones into numbers. That's how you need to see this.
Yeah, makes sense. And I think answering Ankita's in terms of phase 3, I think you should think about how relevant it is for you. So if your innovation or your proposal is in track 1, probably not as. For startups, obviously, it's an important part of your selection of getting into phase 4. But I think for phase 4, it becomes more crucial because you're ultimately presenting to a lot of investors on the demo day, right? So having slides and thought through material on these aspects become important. Now, obviously, given that there's just so much diversity of ideas, and on technology scales, these ideas are at different levels, cultivated fermentation and plant-based. There might not be as nuanced, models or financial projections or future projections for all of you in place. So that's totally fine. I think we evaluate your proposal based on everything else within that proposal as well. So as long as you're accounting for the evaluation criteria and the weightage therein for such a provision, I think you should be fine, Ankita and Yash. But the answer really here is it depends. The better you have thought about it, it's going to add value for sure. If you have not and you focused on other areas because that's the need of the hour, I think we'll account for that as well. So yeah. Pratik, you don't need to share any balance sheet as part of phase 3 proposals per se, but you can give some sort of a summary dashboard level information of what those key expenses, costs, revenues might look like for you. That basically helps somebody think, okay, have they thought through what is going to need, like in line with advice from Divya, right? So I think that should be fine. I think there's one more question from Bhavin. You might want to take, Divya.
Sure. So in terms of where do you get existing information on Good Dot or Imagine Meat, yeah, these are private companies. It's really difficult to try and get this information. So unfortunately, this is just not possible. So we can only work with publicly available information.
Yeah, and my advice for you, Bhavin, would be talk to more founders, right? Once you develop that informal set of network within the founding group of companies, like, Debabrata is one example that he's thinking about these things. You've gone through some experiences, great connecting with him. But at the same time, more mature startups in the ecosystem, I think all of them are private currently, right? Beyond, we take this example because it's a publicly listed company. All of the data is available. So you should look at more public companies to see globally if you can get access to their financials for benchmarking, or at least understanding the different parameters that on which they're thinking about their expenses, revenues, etc., R&D. One usual tidbit that I would love to share is usually the R&D spendings for smart protein or alternative protein startups is much higher compared to their overall budgets, compared to, say, FMCG companies, which are relatively more established. So things like that, I think, on a qualitative basis, if you're able to convey during your pitch as well with investors, that would be helpful. Yeah, so that would be my best suggestion there. Yeah. I mean, any thoughts, Divya, on what kind of R&D budgets you've been seeing for startups and what are like acceptable ranges?
So this vary tremendously depending on what kind of startup it is. For a high tech, for a food tech startup, this might probably be much higher, somewhere around 50%. Sometimes even 100%. If it's a precision fermentation company, almost everything's going into R&D. And in the at least in the initial years, all of these numbers are for the first 3, maybe 4 years of operations. And for a CPG company, this would be vastly different. So it may be somewhere around 10% or 20%, depending on how much you have in terms of fundraising capacities.
Awesome. Great. Yeah. So I think we can move on for now, and I'll recommend everyone to submit your questions a little bit with more context so that it's customized to your case. If not, you can feel free to, just raise your hand and I can promote you live and you can ask your question directly. Yeah. Please go on, Divya.
Okay. Sharing my screen again. So this is a bit of an exercise, and I hope all of you can type in your responses in the chat. I'll keep a close eye instead of the Q&A. Okay, all right. So here we have an income statement for the first month of Jan 2021 for a startup. You don't need to know in terms of what sector it is, just bear with me in terms of the numbers. So let's say you have a revenue of 1,000. Your cost of goods sold is somewhere around 700, which gives you a gross profit of 300. You have employee costs, marketing costs, general administrative costs, and all of this together comes to about 200, which leaves you with an operating profit, or your earnings before interest, tax, depreciation, and amortization, EBITDA of 100. So your total EBITDA by revenue, which is your EBITDA margin, or your operating profit margin, is somewhere around 10%. So my cash balance at the beginning of the period was around 300. How many of you think that my cash balance will be more than 300 at the end of 31st Jan?
You can type in your responses in the chat. If you've calculated the exact, we can give them 30 seconds while they're thinking through this.
Yeah, so I don't need an exact number. I just need to know if it'll be more or less. All right, Srirang. Okay. Okay. All right, so it looks like we are leaning towards less. Okay, and how many of you think that it will depend on a number of things? And if it will depend on a number of things, what will it depend on? All right, Srirang, great. It will depend on the credit cycle. Okay, on supplier and customer, great. It'll depend on variable costs. Akshay, but do you want to elaborate that a little bit? What do you mean? Okay. Okay, all right. So like who pointed out, Ronak said it'll depend on a number of things. Srirang said it'll depend on the credit cycle, and they are both right about this. It will depend on their credit cycle. It'll depend on their working capital cycle. And I just want to quickly go over what this might look like. Let's assume in this case that typically if you have sold 1,000 in Jan, normally the credit period is around 60 days. 60 days would mean that you would get the money for the goods you've sold in Jan only by March. All right. And in the meantime, you have your COGS, you have your employee costs, you have your marketing, you have your general administrative costs, and all of this together, you're spending about 900 that's going out from your company because you need to keep your company going. You will also then add the operating costs that you will need to incur for Feb, because you will get Feb's revenue in April. And that's why your cash position at the end of the period will be far, far worse. And this is why you need fundraising. This essentially, all of this is called your working capital, assuming that all of these expenses, you get no credit period because you're an early stage startup, suppliers do not trust you, and therefore they're likely to not give you any credit. In fact, they might even demand payment in advance. In some cases, what happens is with sales, retailers might even say that they will only pay you once they have managed to sell your products in the supermarket. And that might delay your sales cycle even more. You might get your money much, much, much later. And that complicates things. And this gap that you have between when you actually sell your product to when you receive the money, this is essentially what needs to be funded. And this is your working capital that needs to be that needs to be funded. And this is why you need a lot of money going towards working capital during this early stage. Any questions at this point? Is this concept clear?
Any questions, guys? So I think people are mostly clear with it, but if you have any questions, feel free to raise your hand, guys. Yeah.
Okay. So I'm gonna assume that everything's clear and share my presentation now. Okay. All right. So we went over this. All right, so what exactly is the difference now? Profitability measures your earnings versus your spending, and cash flow measures your cash in versus your cash out. And what happens if profitability is negative? You can still survive as a business if your cash flow is still positive. Survival is extremely unlikely if your cash flow is negative over an extended period of time. And typically for early stage startups, this period doesn't end for a very long period of time. So you need consistent fundraising to kind of manage your business, at least for the first 5-6 years. Okay, and then we have the balance sheet, again, important because it gives a quick snapshot of everything that you owe as a business and everything that is owed to you. And it gives a very good picture of all your assets and your liabilities. Where has the money been going? How has the money sort of come in? This is also where the capital table is involved. And this is also something you need to pay attention to. So what are the quick heads? I'll just go over them. Current liabilities are all the payables, all your suppliers that you need to pay, the credit period you get for the products that you're purchasing. Typically, initially, you have little to no credit from your suppliers. And as you grow and as you build that trust with your suppliers, you might get an extended period of credit. And that's the goal you should have, to try and get as much time till you have to pay your suppliers. Then you have your long-term liabilities, any loans, convertible loans as well will be part of this section. Everything that needs to be repaid or has an interest will be part of this section. It could also be advances. It could be a number of things. I don't want to go into too much detail here, but yeah, these are the long-term liabilities which will be on your books for longer than 12 months. Then you have shareholders' equity. This will include all the equity capital that has been infused into the business, and it will also have accumulated earnings year on year. Like it'll be a total number of cumulative earnings that you have as a business and cumulative losses that you have as a business. So everything that's retained net income will come in here. Then you have application of funds. You have your current assets, inventory that you need to keep, say packaging material that you need to purchase in a certain minimum order quantity that you have with your supplier. This inventory you will purchase and keep in a warehouse, and that will be inventory that will reflect on your books over a long period of time, maybe. Then you have receivables. Everything that your customers have to pay you will be part of this section. Then you have long-term assets, your factory, all the equipment in your factory, any property that you have like laptops or office desks, and anything of that sort will come in under here. And finally, the most important output is here, the cash. The cash will come in from your cash flow. So it will be a result of the cash flow statement that will come in here. All right. Questions here. What kind of founders equity you've seen in brand new startups? Do they generally take sweat, paid up, management, incentive, etc.? This will matter most as startup grows with institutional. Yeah, you kind of answered your own question there, Bhavin. Yeah, this will matter more as the company, as the startup grows and you have more institutional investors coming in. Of course, you will have ESOPs. This will be something that you will apportion, but this is something that comes in a lot later. Like normally during your first institutional round is when you would go and figure out how much to keep in your ESOP pool. All right. Okay, I think that's about it. Great. All right, so just quickly going over the statements. You have your income statement, which is income statement, balance sheet, and cash flow, and how these are all different. In terms of time, your income statement is for a period of time. Your balance sheet is for a single point of time. So it reflects your balances as on a particular date. And your cash flow is also for a period of time. So it could be 3 months, 1 month, 12 months, whichever. Purpose, your income statement measures profitability. Your balance sheet shows the financial position of your entire business. And cash flow shows the cash movements in and out of your business. What does income statement measure? It measures your revenue, expenses, and profitability. Your balance sheet measures your assets, liabilities, and shareholders' equity. And your cash flow measures the increases and decreases in cash. What's the starting point for the income statement? You start with the revenue. For the balance sheet, you start with your cash balance. And for the cash flow, you start with net income and then add things as you go forward. What's the ending point is you have net income, which then goes into retained earnings here in the balance sheet. And then you have, all right. So any more questions?
No, we can go on. Yeah.
Okay. All right, cool. So this is what you have to ensure, like basic sanity checks, no circular references, check formulas again to ensure that you have not missed a cell. Ensure your cash balance is always positive. Again, speaking from the experience of receiving a lot of models which have these basic mistakes, it sets a really bad impression. So please try and ensure that it makes sense. Assets are always equal to liabilities in your balance sheet. So please ensure that there are no hidden numbers within the formulas, and don't hide or group columns excessively. It makes it very difficult to kind of read and understand your model as somebody who hasn't worked on it. So just keep these things in mind. All right, just gonna run through scenario analysis. I see that we're already running a little behind on time. Shardul, how are we on time? All right, okay, I'm just gonna continue here real quick. So the numbers aren't specifically important, but I'm just trying to give an understanding of how dramatically your fundraising amounts change, how dramatically your working capital requirements will change, and how much your runway how different your runway looks when you have different fundamental assumptions. So here you have your base case, which is essentially, I'm estimating 900,000 in terms of revenue with 700 points of sale. My COGS is at 60%. I'm assuming I have 8 employees, a marketing spend of 230K, and a cash conversion cycle of 60 days. That's 3 months or so. And then you have 2 months. Then you have your break even here, which is happening in year 2. Again, just a hypothetical scenario. This is very unlikely to happen in the real world. You have your break even in this case happening in year 2, monthly average cash burn of 12K per month. Working capital required is 275K. And I'm estimating, based on all of this, the output of my model is that I have 12 months between fundraisers, and my total fundraising requirement is 300,000 euros. All right. Now I'm changing the scenario a little bit, and I'm trying to understand what it might look like if I'm more aggressive in my estimations and in my milestones. Let's say I want 930 points of sale. My COGS is even better than I imagined, and I'm able to get a good term with my supplier, and my COGS reduce from 60% to 55%. COGS is cost of goods sold. And my number of employees is probably increasing to kind of achieve this additional, more ambitious milestone that I'm setting for myself. Can anyone walk me through what marketing spend might look like? I just need to know if you think it's going to increase or decrease.
You can reply in the chat. Increase. Jay says increase.
All right. Quite similar or lesser. All right. Okay, yes. So essentially what would happen is, for me to be, in order to achieve these higher milestones that I'm setting, I have to be more aggressive. Customers probably don't know anything about my product, and they will need more information. I'll need to get my brand name out there. So my marketing spend will increase more, all right, in this scenario. What happens to my working capital cycle? If I am an aggressively pushing, yeah, so this also will increase, correct? Yes, it will go up because I might be more lenient with my customers and tell them to stock my product, give them very flexible and good credit terms so that they take my product and stock it in their shelves. So this normally drives up my cash conversion cycle because I'm trying to onboard more customers. All right. So what do you think happens here and then in this case? So in my base case, my break even is happening in year 2. What happens to my break even in this scenario? Okay. No, this wouldn't happen because I am now spending a lot more in terms of marketing. My cash conversion cycle is much more stressed. And therefore my break even might in fact get pushed. This is more likely. And what happens to my cash burn in this case? Even though my COGS have increased just a little bit, do you think that marketing spend and cash conversion would be within this? Everything, yes, correct. My average cash burn will increase. My working capital requirement will also increase. What do you think is the impact? Does anyone want to venture a guess in terms of runway between fundraising? Do you think this will improve, or will it be worse? Will it reduce or increase?
It should reduce, yeah. It depends on how much funds. Oh, it's given that we've raised a specific amount of funds and then we're kind of thinking about it, right?
No. So what would happen is you might have to go more frequently to kind of fundraise because you're spending a lot more. Your average cash burn has increased and your working capital requirements have increased, and therefore your runway between fundraising might reduce. So you might need more money. And this obviously leads to your fundraising amounts also being much higher. So you might need to raise 700K. All right. I'm just going to run over the stress case scenario real quickly. All right. So in my base case, yeah.
I'm sorry to interrupt.
No
Ma'am,
idea.
in the last scenario of 55% COGS and all, ma'am, if the
Mhm.
COG is reducing the price parity, also means price parity to the common product, which in the plant-based or animal or cultivated in the meat products industry, which be more preferable. So, ma'am, the chances of improving the this overall the relation with the customer and all the company success rate with the break even should decrease.
I'm not sure I fully understand your question. So you're saying because COGS has reduced, my gross margin has increased, and therefore my break even should actually be lesser.
Ma'am, in the current in our for the food industry, for most probably in this alternative protein industry, I'm most probably speaking about that. The break even should be achieving more early as opposed to in this scenario, I suppose.
Yeah, that could be possible. However, my marketing spend and my working capital requirements have also increased. And that then has another consequence where my cost structure now is more demanding from a different perspective. So even though COGS have reduced, my marketing spending has gone up.
Okay, ma'am.
So it's pushing my break even. This is just a case that I'm presenting.
Yeah.
So of course, it can look very different for different startups. All right.
Okay.
Okay. All right. Cool.
Thank you.
And then we have the stress case where you have 700 points of sale in my base case. I'm assuming that it's more challenging for me to kind of fundraise. In this scenario, I am not able to get a lot of investors to take a bet. And they want to see more traction. They want to see more validity of my business model. So I need to manage with limited funds. All right, that's the scenario, the stress scenario. So I'm assuming that I'll only get to 400 points of sale. My COGS will be around 60. It could be worse. The number of employees I have is lesser. My marketing spend then will most likely reduce. What do you think happens to my cash conversion cycle in this scenario? Yeah, no, in this scenario, again, my cash conversion cycle is still going to be bad. Suppliers are still not going to be more lenient. Customers are still not going to care so much that I'm not able to fundraise, and therefore it might still look drastically the same or maybe even worse. And how does this affect break even then? What do you think? No, break even is also likely to increase, everyone, because I'm not able to achieve scale. I'm not able to achieve efficiency in terms of operating costs, and therefore my break even is likely going to get pushed further because my revenue is really tiny, with only 400 points of sale. What about monthly average cash burn? This is also likely to increase because of demands that I have in terms of COGS. Probably I might not have a very efficient business at scale, because of which my cash burn might increase. My working capital thankfully reduces overall in terms of value, in terms of the value number. So even though my cash conversion cycle is extended, my working capital requirement in terms of value, because my revenue is lesser, this will also be lower, and that thankfully gives some relief to my operations. What happens to the runway between fundraising?
It reduces.
Correct. So this again reduces because I have now much lesser funding abilities, and therefore I probably am not able to sustain this for too long. And what do you think happens to the fundraising amounts? This increases a little bit because I'm not able to kind of manage the kind of revenue is not very high, because my points of sale are lesser, and therefore my fundraising is a little on the higher side. All right. So just wanted to kind of present. So I would really encourage all of you to kind of do these different scenario analysis so that you know what are the upper limits and the lower limits in terms of your fundraising, so that you're prepared for different scenarios as they play out. Okay, any more questions at this point?
We'll take them, I think, towards the end, and I think we
Okay.
can go to, yeah.
All right. So quickly moving through due diligence and fundraising, then like I mentioned earlier, the average fundraising timeline is 6 months, but that's the absolute lower limit. It can be much, much longer. In terms of information readiness, sorry, ignore the information checklist in the shared folder, but in terms of information readiness, you have your business plan, your detailed pitch deck, founding team, employee information, your employment contracts with the company, very important, missing a lot of times with startups. So I would encourage all of you to frame, to draft these agreements. Operational contracts that you have, supply contracts, customer LOIs that you might have, any tie-ups you have with advisors, strategic advisors would be really relevant to be in the data room. Incorporation documents, shareholder agreements, all of these things, term sheets, or any other. If you have already managed to raise funding, then all of those agreements also need to be in the data room. Product samples, very, very important and necessary. So please ensure that you're at a stage where you can either show a video of your prototype or can ship your product samples to investors. It really helps to kind of make a decision. Traction data, if you're post-launch, how much revenue have you made? How many points of sale are you at? What are the gross margins? Site visit, if applicable, but this normally happens for much larger institutional rounds, so you don't need to worry about that at this point. All right, in terms of, I think Prateek asked this question earlier, how do investors evaluate startups? Just gonna run through this real quickly. The first and most important aspect is, of course, the team. What is your experience to kind of build a company? What is the approach you have to decision-making, to problem solving in terms of strategy? How are you going about these things? Is the founding team working well together? Are they coachable? Are they open to feedback? These are all things that are very important and important when you're evaluating, because it's a longer term relationship. You have to work with the founders. So these are the things. The softer skills are also equally important. Market potential, how big is the market? Is there enough space for this startup? Is there enough promise for the startup to kind of take a percentage of that market share in the near future? Products USP, is this a compelling enough USP, or is it just a value added? Is it just an additional feature to existing offerings in the market? So how compelling is the USP? Defensibility, can the startup protect itself against competition? Does it have trade secrets or IP or any patents of any kind that can prevent competition from eroding its market share? Competition, how competitive is the space? How far along are the competitors? Are they, how much have they raised in funding? How far along they are? Pricing, are we close to the competition's pricing? Are we very far away? Are we coming in at a premium? Are we coming in at a discount to what competition's offering, and why? Business strategy overall, like I mentioned, in terms of pricing, in terms of go-to-market strategy, in terms of product strategy, IP strategy, all of these things together form this, and they're all very critical. If you're a tech startup, then IP strategy is probably the most important aspect, and I would encourage you to have a document describing what your strategy is in terms of IP. Models viability, how solid is your financial model? Have you thought about it from different aspects? Does it seem practical? Does it seem achievable? Does it seem too ambitious? Generally, investors like ambitious and aggressive models. But I think it's a fine balance between looking practical and coming across ambitious. So I think you need to find that balance in terms of what's achievable and what's too optimistic. So just keep that in mind. Validation and traction, of course, really important and great to have if you are post-launch. Very difficult to kind of come across. So what do you do pre-launch? You can have LOIs with customers. You can have customer validation studies that you can do in a controlled environment. Just anything, like you can have a small pilot launch, which doesn't require a lot, and test it out in a small geographic market. There are a number of things that you can do even with limited funds if you're pre-launch. So yeah, just some things to keep in mind. With that, I think this is the end of my section. I will just give 5 minutes for any questions at this point.
Yeah, I think what we can do is we can invite questions over chat and Q&A, and you can participate in those while Debabrata and Pranjuli is kind of giving their presentation.
Sounds good.
Yeah, I think. All right, so I have Debabrata, who is the founder of ProMeat, and Pranjuli, who again is a co-founder of ProMeat, to go on with their deck. On to you, Deb.
I think I would like to start here. So
on to you, Pranjuli.
Yeah. Hi everyone, Pranjuli this side. I'm the co-founder of ProMeat. So at ProMeat, we create delicious and healthy plant-based meat products like burger patty, nuggets, kebabs, sausages, etc., which are liked by the consumers as per our studies, and which are not just tasty but also affordable. So our products are specially curated to suit the taste of India's meat lovers. And now I would like to move on to our journey and go through it and let you know what all we have been through in the past 1 year. So we created our first prototype a year back and demonstrated our idea last year in the India Smart Protein Innovation Challenge by GFI India. And it really helped us understand the smart protein market in India as well as abroad, the supplier and flavor houses that are present in India as well as in other countries, the available technologies and the solutions that are already present in the market, and really helped us understand how to scale an idea from considering important points like understanding more about the TG, the target group, to the point of sales, the business model, unit economics, and more. So after diligently working for about 5 months or so, we went on to win the challenge and invested our entire prize money for the product development and trials. So, but the prize money was a little amount, and to do more R&D and product development, we initially required more funds. So at that time, we applied for certain government schemes and received some more support from that. So that really helped us kickstart our product development journey. So moving ahead, we took part in different international challenges as well. That really helped us narrow down the gaps in our product and started working on them. That time we emerged in the top 3 teams globally in the innovation challenge by Unilever. So that really helped us understand the technology better and work on the gaps that our product specifically had. So further, I think at that time, our journey really kickstarted when we got incubated by Proveg. So we were at very initial stage that time, and we only had our first prototype ready. But Proveg gave us the right direction to move forward with our product. They really helped us align our timelines and milestones, which not only helped us in achieving the goals quicker, but also helped us in setting more achievable goals. So most importantly, they had a great mentor panel that helped us whenever we faced any challenges. Also, they assign you a separate mentor. So we had Albrecht on our team. He really helped us, guided us in the entire process. Also, Divya really helped us a lot with our financials. So we really struggled with our financials at first, but she really helped us out. So that was that really helped us. Further, most importantly, they had mentoring sessions that covered specific topics like branding, sales channels, legal aspects, finance, investment, pitching, and more. So it really helped us in starting to work on these aspects. So moving further, we did some commercial trials and sent samples to different stakeholders in the smart protein space for feedback. And during that time, we also got an opportunity to be incubated with IIT Kanpur to get more technical as well as financial support. So that time we developed our entire product line as well as did nutritional studies as well as textural profile analysis on the products. So moving forward, we received the EnviroCare Green Award out of 100+ top companies in October 2021. We also did some more tasting sessions as well as consumer surveys to understand the market and the TG better. So that was our 1-year journey. And following that, we started working on our packaging and branding. So that is still ongoing, and we are very, very soon going to be launching our product in the Indian market. So during the entire journey, we faced a lot of challenges and tried to overcome them with as much as we could do. So initially, it was it was very difficult for us to source various protein isolates as well as TVPs of good quality at an affordable cost. So we tried importing isolates like soy protein, mung protein, pea protein from suppliers that those were outside India for our product development. But moving forward, we realized that it really increased the product development cost for us, and which was not really suitable for the Indian market. So we started connecting with local suppliers and closely worked with them to get the desired ingredients as per our requirement. So eventually we were able to draw down the cost for some of our ingredients to about 15 to 25%. So that really helped us in reducing our product development cost. So the next challenge was acquiring market data specific to India. So I think that is a common problem that I think all smart protein innovators have faced over time. So we tried to, since the data specific to India was not available, so we tried to look for data in the APEC region. And in fact, GFI India resource database really helped us a lot to get more insights about the market as well as the consumers. Also, their buying capabilities and the requirement, what a consumer requires from our product. So we also ran our own survey with in partnership with our ingredient supplier as well as our own face-to-face surveys to get some more consumer insights. So moving to the next challenge, after developing the product at a lab scale, we were looking for a manufacturer who could with whom we could do a commercial trial. So that was really challenging for us because at that time only few selected third-party manufacturers were present in India who could actually let us do commercial trials with them. So it took us a lot of time to closely work with them and do our commercial trials and finally develop our product. So finally moving on to the most challenging part. So that was during COVID-19, our entire team was working remotely from different locations. So it was very challenging to keep everyone motivated and to achieve our goals on time. Also, it was really difficult to work on R&D and do trials because all the labs were shut, and we really had to look for contacts and how we could leverage those contacts to actually get access to labs. So that was a difficult time period for us. So moving on to some of our key learnings throughout the journey and the challenges that we faced. So firstly, we would like to suggest that before you start working on R&D, you should look for the existing market and the existing ideas that are already present there. You should first go through the existing products that are there and try to find out gaps in them and then start working on R&D. That would also help, that would not waste your time moving ahead. Secondly, reach out to industry stakeholders and mentors and get feedback on your idea. So I remember initially at the time of GFI challenge, that really helped us a lot. We reached out to industry mentors. They helped us with our pitch. They helped us refine our ideas. So that was really helpful. Further, try to take part in challenges like GFI Smart Protein Innovation Challenge. So that really helped us kickstart our journey because it gave us an idea on how to start moving ahead from just a product to a commercialized product. So I remember we had to work on our unit economics as well as the business model, as well as what all points of sales would be there. So all these details we had already figured out during the challenge, and we after the challenge, we started working on these. So it really helped us refine our proposal as well as take the idea forward.
Something I'd love to add here, Pranjuli, on your point. Actually, what would be super useful for all the startups who are in an early stage, right? Still thinking about, okay, I don't have everything ready, right? Like after this kind of a presentation, you might feel like, and you might see other people who have applied to international cohorts, who've already formed their ventures. So like I said, what we as judges are looking at is a cohort of people at all stages and kind of promote them for the demo day. So, try to be one of those who are trying to figure out all of these answers and putting them, in a phase 3 proposal format. And that would help you guide your phase 4 kind of outputs for the demo day. And that would really help you build that base, which would be crucial for you to then apply for all of these programs and get your journey started. So just on the point of what Pranjuli was saying, I'm just adding on a little bit onto that. Sorry, please go on. Yeah.
Yeah, sure. I think I completely agree with Shardul here. Also, during the GFI challenge time, we really worked on these aspects, which also helped us apply for government grants as well, because we had already figured out those aspects. So it was easier to refine the proposal and, reach out to more people to help us out. So that was really helpful. Further, I would like to say that make a proper fund utilization plan and cash flow, as Divya already suggested in the workshop. So during Proveg, we really worked on our financial proposal, and Divya helped us a lot. So that was really helpful for us moving ahead. Also for the investment round, try making your investment the cash flows in INR as well as in US dollars, because that would really help you reach out to more investors, and they would be able to understand your proposal better. So that was one thing. Now I would like to if Debabrata wants to add anything here and just give his learnings and suggestions, that would be helpful.
Like, I'm super impressed to see, last year I worked closely with Shardul to channelize and everything to make this challenge possible, and we worked really hard to take all the participants to take part in this whole challenge. So now seeing everyone here in this whole challenge, it's really motivating me as well to take part this year as well. So our whole team, we are this year also we took part, and we are working diligently in all the aspects, making the reports and everything. So looking forward to your questions. We're happy to answer whatever you want to ask for.
Awesome. Thank you, Dev. Is there an additional slide after?
No.
All right, great. So I think thank you for that addition. And for sure, I mean, for 3 years, starting with a very few set of startups, and now I'm sure a lot of you participating in our audience today who are watching this recording on our YouTube handle would be the ones who'd be speaking in our sessions going forward, in our events, conferences, summits. And it's always great to see on-ground action happening and really seeing companies being built from scratch. That really helps motivate, I think, a lot of first-time founders to think about what are the possibilities, etc., in terms of their own venture. Having said that, I think what we can do is take a few Q&A live. We still have 10-15 more minutes, and I know that Divya has been answering a few on the Q&A button. But Divya, if you want to add anything from the existing set of questions that you just answered, just the question and what your answer was, I think that would help. I think one was with pricing and discount, and other was around.
Maybe we can take any questions that come up now. And if there are no more questions, then I can elaborate on my answers for the questions.
Hello. Yeah.
Yeah, I just wanted to check with ProMeat team about the their journey. They did share their journey. Thank you so much. I just wanted to check that when you have participated in so many incubators slash different government or those different events. So what do you think that it's why is it so challenging to raise equity despite participating in all those events? So what is your learning there?
Okay, so answering to this question, it totally depends on your background and how exactly your team is formulated. So if you don't have financial crunches, then you don't need to go for government grants. So basically, we are recent graduates, and we are totally devoting our whole time for this, and we are not have much funding support in the back to develop the products. So we're looking for initial developments. So after putting initial investments, we are able to achieve initial product. So to refinement of the product, we need more funds. So that's why we are looking for government grants, and we applied for them. And like while during that period only like Proveg we got incubated there. So the like from there only like it's really kick-started our whole journey. So we like formulated each and everything. We expanded our team. We worked on not only in R&D, we worked on strategies, branding, marketing. So in all the aspects, we deep dive into the same, and we have done multiple researches in terms of understanding the customers feedback, customers requirement, and what exactly the products customers are looking for, because at that time very few companies are there. Only Good Dot is doing a different scale, and like
Yeah.
Blue Tribe is just launched their products, so
Yeah.
very few data is available. So we are stuck like to understand what kind of product we should develop and where exactly we can place in the market. So we have also reluctant to feel like where exactly the price points and the price gap is there in the market. So we done some research. We understand. We like we, still I remember like we have around 7-8 members of team who like diligently work on like uh, talking to different stakeholders, talking to different customers. Like we have 1,500 sample size of uh,
Yeah.
like survey we have made through to understand the perspective. So after that only we did this everything. So I
Yeah.
think it totally depends on your status and moving forward.
Makes sense. Makes sense. One more question I had on the
Yeah.
ProEdge incubation from Divya actually. Divya, do we if some I just want to give a hypothetical example. If somebody gets selected at your place, I see you also provide some funding there as well. How much equity, or how does it work? Do we take some equity there in the on those companies, or if so, what are the ranges in? If you can just share some details.
Sure. So in our web, like if you go to our website, you will find a document. I'll see if I can share the link here in the chat. You'll find all the information there that we can publicly share. A lot of this information in terms of how much equity we take for the program participation, how much equity we take for the funding depends on the startup as well. Like we will evaluate the startup and then determine what valuation we want to get in at, or what stage they're at. So if there's a lot of traction, if it's in a geography that's relatively unexplored, if it's in a market that has tremendous potential, then the valuation might look very different versus how the valuation looks if these are all different scenarios. So yeah, I can't really give you a specific number there.
Okay. All right. But can you give me as a range in here?
So I'll tell you how much we invest. So we have 70,000, which includes our program cost as well, plus 20,000 in cash, which comes in at the beginning of the program. So 70,000 investment for which we take some equity, and then we do an additional follow-on investment of 180,000 euros, which comes in at a later point of time, depending on fundraising strategy and depending on the startup as well.
I think that should suffice. Thank you so much.
Great, thanks.
Thanks, Priti. Indra, do you want to
Hi,
ask a question?
Sure.
Sorry, Atisha, before we go on to you, I see Indra's hand up. Indra, do you want to?
Yeah. So hi, I have a question for Debabrata. So maybe you could answer this. And in your presentation, you had mentioned like identifying the potential co-manufacturers. So how did you go about this research at first? And what are the major considerations that you had to like take in order to like find the co-manufacturer that actually fit your ideal description? Yeah, that's my question.
Okay, so for that, I will suggest please reach out to GFI India team. So they will help you to like give us a list of manufacturers available in India as well. So we searched in different aspects, like we look for the SKU size. So with whom exactly we can do our commercial trial, and like at what how much exactly we need to invest for the same, and where exactly they are located. So 2-3 things we move forward. Then we understand that like lots of manufacturers don't have the right amount of equipments to develop the same kind of product. So then the main challenge comes in. Then we'll make a list of equipments, what is needed for our experiments to be done at per our cost. Then we figured out with whom exactly we can tie up and with whom exactly we can do the commercial trial. So whenever we go for any commercial trial with any of the person, then we go and check whether these equipments are available with them or not, like what kind of product they develop. Then we like formulate and everything, and we put up investments for the same to do the raw materials and procurement and everything. So now in the Indian space, like I see like lots of manufacturers are coming in. There are like Proveg, like so many product manufacturers are available in India, like 7, 8 manufacturers are available in India. So I don't think for plant-based industry now you face much problem in terms of finding the manufacturer, but you might face problem with the but as per the capacity, because mostly manufacturers go for 3 ton, 2 ton, that kind of capacity they ask for. So being a startup, we can't able to give that much of like initial orders to make the initial commercial trial. So I would suggest negotiate with them, try to go for 300 kg or 400 kg, so that we can able to sell that amount of initial commercial trial or initial trials. Then we can move forward with the number of orders in coming years.
Yeah, thank you. And I have a follow-up question as well. So how do you like
Sure.
how did you approach this licensing of IP with the co-manufacturers?
Okay, it totally depends on you. Like if you have IP within you, first you need to understand how exactly you want to protect it. So in India, like it's very tough to protect your own IP. So I would suggest go with your own formulation and see how exactly you can protect your IP in what way. So if you are gonna give the entire formulation to them, I will suggest go for first NDA and do initial agreement. If you don't give directly orders to them, but then also you go for initial agreement with them that they won't disclose the things. Then also I will suggest don't give entire formulation. Try to make the premixes of your product. Like for example, if you add any kind of seasoning or any binders within the product, I will suggest go for initial small batch of premixes, give it to them, ask them to make the entire range of products for you. In that way, you are not disclosing the entire recipe of your product to them, but you're getting the right amount of product. First, need to check whether the product is being made by them is you are getting the desired amount of texture or not. If you're not getting the right amount of texture, then it's not feasible enough to go with them. So like without disclosing your recipe. So we exactly strategize in that way, and we seems it's very like helpful for us.
Thank you. Thank you very much.
Yeah, thank you so much.
Atisha?
Yeah, so my question is for Divya. So I want to ask, so for ProEdge incubation program, I think it's 4 months. So I just want to know, like, how are those 4 months structured? Like, are there certain milestones set by you guys that we have to achieve? And what are those milestones?
Yeah, thanks, Atasha. I just shared this link in the chat. You'll find more information about our program and our our services there. In terms of how it's structured, you'll find more information there, but we try to cover a lot of workshops which have a lot of topics, much like this one you're currently going through here at GFI, and we try to be as comprehensive as possible and tailor the program to the needs of the startup. We also connect you to mentors within the space. A lot of our mentor networks and corporate partners and all of these people within this within our networks are international. So you might not find a lot of India-specific mentors, though we do have some of them. So you have to evaluate based on your own requirements if this is a good fit at this point of time. What was your other question?
No, it was just about the milestones, like
milestones, right? So at the beginning of the program, we have a discussion with each startup to kind of understand what stage they are at, how and do a proper assessment to kind of get a comprehensive view of the startup and what next steps they need to go. The idea with the incubation is to kind of help them get to that next stage in terms of fundraising, prepare them for that, a very important step. So that's the whole goal we have. So milestones differ from startup to startup. So I can't really give you a specific comment, but fundraising is a key topic that we're trying to cover in most of the milestones. We also have some product specific milestones. We might also have marketing specific milestones. We can also have R&D specific milestones depending on the type of startup it is. And we try and achieve that in the 3-month period and try to facilitate those milestones as much as we can.
Thank you.
Sure.
Awesome.
Thanks.
Great. I think we'll have a last call of questions. So if anybody has a pressing question which they would like to ask now, depending on the topic of the session, what Deb, Pranjuli, and Divya have spoken about. I see Bhavin. Yeah, Bhavin, go on.
Yeah, thanks, Shardul. Divya, I just on a question which I posted in the Q&A. So my question was mainly related to what kind of institutional investor profile we have seen into the sector which has already started for last 2-3 years, because the sector is very new in India, right?
Mm-hmm.
So has there been any institutional investors who has been investing into this sector? Because I looked at net as well, but I could not find anyone. It's mostly through the bootstrapping or to the GA.
Yeah.
So I can add a few thoughts there before Divya kind of jumps in. So we obviously have a very specific database for all the startups looking for fundraising, right? If you sign up for that, you'll get access to our investors directory. We've been educating a bunch of VC, institutional, family funds, across the entire spectrum of investing, right from angels for the past 3 years, Bhavin. A lot of them are in our GF Ideas India community to begin with. So all 1,000 names you see, those are not just names, right? Those are actual real people bringing about change in the industry, whether they are investors, corporates, facilitators between the two, etc. So I'd suggest connecting with some of them. But Nicole, if you're still here, would you like to jump in and perhaps share some thoughts?
Yeah, so we also support a lot of startups on fundraising. So we usually ask startups to prove that they're fundraising by sharing a pitch deck with us. We give you feedback on your pitch deck, and then we also give you access to an investor directory that we maintain. And within that directory is a list of investors, both within the Indian market as well as outside of the Indian market, who are interested in particularly investing in startups in the Indian ecosystem. So you'll gain access to that as well. And then we also do one-to-one introductions to investors. If we feel there's a match between the product that you're putting out, as well as what investors, we've been speaking to investors about and where their thesis is. And if there's a direct match, then we'll do a one-to-one introduction as well.
Okay, sure. Thanks.
And I think, Bhavin, just as a follow-up for a lot of the teams, as you go through this challenge, right? And as you go into demo day, automatically you'll get connected with a lot of people who attend there. And then as a follow-up of it, we'll share that recording with a bunch of people. You can use that to share it in advance with your email and LinkedIn connections to a lot of these investors who might be of interest to you, and take it from there. So that's how the funnel kind of improves as the startups become a little bit more mature with their decks, etc., in place, with their plan of production in place, at least some sort of MVP in place. Then it becomes much easier from the many individual founders of startups that might be writing to us every day with interest in the sector, Bhavin.
Okay, sure. So Shardul, if I want to invest, so can I reach out to you guys for somebody looking for investment or finding a co-founder, something like that? Is that possible?
Yeah. Please connect us over email, and we'll again take you through all the resources that are probably already shared with you, Bhavin. But take a look at all of those and then get back to us with the more details.
Getting confused, hence I was asking for some help. So maybe if I can reach out to you separately.
Please do. Please email us.
Thank you.
Sounds good, Bhavin. Yeah. All right, great. I think with that, we probably should be closing down the session. We're already over by 10 minutes. So thank you so much, Divya, for your time today. And I think this is super helpful for our participants, and we'll let them connect with some of you post the phase 4 and also post the challenge. So thank you, Deb and Pranjuli. Again, one just last point, right? Like somebody was asking, I think, Indra, about co-manufacturers. I've been stressing on this point from webinar 1 that Debabrata and Pranjuli are part of our cohort, but I don't know how many of you have actually connected with them through Slack, right? That's the whole point. I think within the cohort and within the communities we have, if you connect with more people in advance, a lot of your questions would get answered. good. And I know sometimes you have to be ready to ask certain set of questions to certain set of people. But I think as you go through this entire journey, you'll find community of support to help you all in our GF Ideas India community. So yeah, just that. Thank you. Any parting thoughts, Divya, Dev, and Pranjuli, starting with Divya?
Yeah, thanks so much for inviting me. It was great interacting with all of you, and hopefully you have some takeaways from this session. If you have any further questions, I'm happy to kind of help out. So reach out to me on LinkedIn or any of these other platforms. Yeah, happy to help you guys.
Great. Debabrata, Pranjuli, any parting thoughts?
Yeah, thank you so much for this opportunity to Divya and Shardul. So basically, whatever like you need help with from our side, just reach out to us. Like whatever experience we have in our last 1 year will help you out with the like in this challenge and for going forward as well. So in terms of in any aspects, you can like reach out to us. Thank you so much.
Yeah, I think it's really valuable to kind of learn from other entrepreneurs' experience in this space. So yeah, and one good thing about the plant-based and alternative protein space is that everyone's willing to kind of, help each other out. So that's been my experience so far. So yeah, definitely do that. Reach out to other founders in the space.
Pranjuli?
I think I would just like to add that good luck all of you for the challenge. And if you have any questions regarding the report as well as like otherwise also, like you can reach out to us anytime. So
Perfect. Thank you so much. So with that, I'll switch off the webinar recording. And once again, thank you all for joining us today. Have a great evening ahead.
Thanks, everyone. Thanks. Bye-bye.